Okay, so we'll be looking at depreciation of fixed assets. And when we are looking at depreciation of fixed assets, we are talking about the loss of value of a fixed asset. So when a fixed asset is losing value, which means it is depreciating. But what are some of the causes of this depreciation? One, we can look at wear and tear. So every time you're using these fixed assets, it is reducing in value because you are using it over and over and over again. So the price that you bought it at and the price that it will be after 2 years of using it would differ. The price will go down. Then also we can look at some processes of becoming out of date. If, for example, you bought an HP laptop, okay, last year, and it was in fashion, and then this year there's another one that will come up that becomes out of date. That PC now becomes out of date and the price will reduce. So all those are some of the examples of depreciation. But then in this video we'll be looking at depreciation methods. But before we talk about depreciation methods, let's look at what are some of the factors that affect the computation of depreciation. Okay, so one, we have the cost. What cost are we talking about? The cost of that fixed asset. So the purchase price. So here we just look at the purchase price of a fixed asset. What else? We're looking at the residual value. What is residual value? Okay, so now the residual value of an asset is its estimated scrap or salvage or trade-in value as for the estimated date of disposal. For example, if they tell you so this estimated residual value is expected to be, or is estimated to be 10,000 of its cost price, okay, so then you know that that is just the residual value. Or in other terms, the residual value is often used to describe the residual value as salvage value and disposal value. Okay, what do we mean by disposal value? So here we can just say disposal, or denoted by, it will be denoted by D value. Disposal value, the amount that we expect to sell this fixed asset. So residual value, we can also say it's a disposal value, the salvage value and the disposal value. Okay, so the amount that we expect to sell this fixed asset. What else are we looking at under depreciation? What other factors affect the computation of depreciation? We're looking at the depreciation amount. So we have depreciation amount. Okay, so we're also looking at the depreciation amount. What is this depreciation amount? This depreciation amount is actually the subtraction of the cost minus the residual value, okay, divided by the estimated useful life of that asset. So what are we saying? The cost minus this residual value denoted by RV over estimated useful life, so estimated years. So this will make sense as we are going to be doing as we are going to be computing depreciation using a lot of methods. Okay, apart from that, let's also look at the estimated useful life. Okay, so estimated useful life is just the estimate that we give to this fixed asset to say, okay, this fixed asset will be used in the business for 5 years. So that is just the estimate. Okay. So we're just looking at the number of years that we expect this asset to produce income into the business. So now let's look at the methods of calculating, and this is our main focus for today. Methods of calculating this depreciation. So the first method, we have the straight line method. The other name for the straight line method is the fixed installment method. So if they give you two names, just know that straight line method is also known as the fixed installment method. How do we compute depreciation? Now, in this depreciation type of depreciation, they'll give you three things, if possible. Okay, they'll give you the cost, they'll give you the residue value, which is just the estimated disposable value, and they'll also give you the estimated number of years to compute your depreciation using the straight line method. So let's give an example. Let's take an example. Okay, so an example says the cost of a fixed asset is 200,000. The residue value, okay, the residue value, let's just give it 5,204. Okay, let me just retake that. 52,400 to make it fair. Then we also have the estimated years. So estimated years, let's say this asset is expected to live in the business for about let's make it 60 years. And let's just name this asset as a building. The buildings can live for a longer period of time in the business. So then how do we compute the depreciation? So we have cost 200,000, residue value denoted by RV as 52,400, and estimated years is 60 years, and building is and this asset is a building. So depreciation, this is straight line, is equal to cost minus residue value. Again, I repeat, residue value, this is the disposable value, estimated disposable value, and RV is the residue value over estimated years, EY, of use in that business. So depreciation, what was the cost of this asset? 200,000. Man, what was the residue value? We said 52,400. Okay, my space is done. So let me just repeat everything. Depreciation, we say 200,000 here minus 52,400 over estimated number of years, 60. So now, if you subtract what is on top there, which is the 200,000 minus 52,400, it will give you 147,600 divided by 60, and your depreciation for the year will be 2,460 depreciation for the year. So this is first year, meaning that since this is straight line, meaning that every year your depreciation will be 2,460. So meaning that this value, this building, the costs of this building will be reducing every year by 2,460 kwacha every year. That's what this value means. Let's look at other depreciation methods. We have the reducing balance method. reducing balance method. Now, this method, mostly they give you a fixed percentage for depreciation, okay, against its cost, okay, so that you compute the depreciation, the reducing balance. The other name for the reducing balance is the diminishing method. Diminishing balance method. Reducing is just diminishing, so diminishing balance method or reducing balance method. Then how do you compute? Okay, so we say they'll give you a fixed percentage, fixed percentage, which is a percentage there. Then they also give you the cost of the building, and this time let's take the cost of the building as 10,000. Okay, so for example, this is the cost of the building, so the cost, and also they will give you the number of years that is expected. So, but mostly, even if they don't give you the number of years expected, you can just compute. They'll just tell you, say, okay, compute for the next 3 years. Let's take an example so that we understand what we're talking about. So let's say the cost, let's say it remains at 10,000, and this is just plant and machinery, and depreciation expense, rather, your depreciation we don't know, that's what we want to compute. Then your percentage, okay, let me just give it a symbol. Your percentage is 20, and finally they tell you to compute the depreciation for the next 3 years. Okay, then how do you calculate depreciation using diminishing balance? So now the cost, this is the formula, multiplied by the percentage. Let me give you the symbol, percentage. Okay, cost multiplied by the percentage will be your depreciation for the first year. What was the cost? 10,000. What was our percentage? 20%. Okay, so 20% of 10,000 is 2,000. So this is your depreciation expense first year. What will be your depreciation for the next year? What you're going to do, first you're going to have your costs, this is second year, minus 2,000. You're going to get your 8,000, then multiply it by 20%. Okay, so what do you have there when you multiply 20% times 8,000? You're going to have your 1,600. So this is your depreciation for the second year. Now, what do you observe? Why do we call it diminishing balance method? If you look at the depreciation for the first year and you look at the depreciation for the second year, you find out that the depreciation keeps on reducing. But for the fixed installment, you notice that the depreciation was just the same. So because of that, that's the reason why we have those names. Now, for third year, let's compute for third year. In your third year, you had 8,000. I mean second year. Then you subtract it with the depreciation for the second year, which is 1,600. You're going to get your 6,400 multiplied by 20%. Then you get your depreciation for third year, which is 1,280. This is for third year. Now they ask you a funny question to say, what was the accumulated depreciation for the last 3 years? What they're just saying is, what is the total depreciation? If you just hear the word total, it's just the addition. So we add this 1,280 plus the 1,600 and the 2,000. So your depreciation for the year would be 1,280 plus 1,600 plus 2,000. So accumulated depreciation for the year will be 480. Now they'll ask you another question. What was the net book value of these assets? Okay. they ask you another question. What was the net book value for this asset in or after 3 years? So now you discover that your costs will subtract it from accumulated depreciation. Okay, so your costs minus accumulated depreciation, it will give you your net book value. That is the formula. So your costs, how much did you buy this asset? It was 10,000. How much is your accumulated depreciation? Here, 4880. 4880. Then what is your net book value at the end of the year? At the end of third year. So minus 10,000, you get your net book value as 520. And this is how you calculate depreciation for the year for both fixed installments and also reducing balance method. I hope this video be helpful. Please subscribe to the YouTube channel.